Ladies and gentlemen, I am really privileged to be the chair of this session where we have 6 very distinguished panelists. Some of them I have known for years, some of them I've just met, but fortunately last night we had the opportunity to share the same table, so we discussed a little bit. And I am totally aware of what's going on, don't worry. I would keep the control. But the topic is a very tough one. We're going to talk about the capital markets. At the opening, I will give the floors to each speaker, and they will be free about what they're going to say. I even give them the right to sing a song, or talk about soccer, but not the match of yesterday, the day before. Of course, this is a forbidden item. Nevertheless, after their opening remarks, it would be, my ability to link everything to each other and to come to a conclusion within the framework of the capital markets, stock exchange, alternative investments. So, you are really a very senior figure in our business, and the floor is yours.
Thank you. Good morning. So, my name is Fawcett. I'm on the investment committee of a company called Permal. Permal is one of the oldest and largest specialist investors in hedge funds in the world. It's a subsidiary of Legg Mason, which is another large US fund manager, not as big as Fidelity, but it manages about $600 billion, and it's listed on the New York Stock Exchange. What I'd like to say a few words about are actually about hedge funds. It's one of the sort of 3 big class of alternative investments, the other 2 being private equity and real estate, and to which you could probably add infrastructure. Now, unlike the other types of alternative asset management categories, hedge funds actually do invest a lot in liquid markets, and I will describe a little bit why they're so important to the markets and to the stock exchanges. So hedge funds have 2 peculiarities. One is they are unconstrained in the way they invest, and they seek to make money out of declining asset prices as well as rising asset prices. Virtually all other investments, people are expecting one of 2 things, either income or capital appreciation. Hedge fund managers will actually deliberately seek to make money out of declining asset prices, and in that they are virtually unique, and they are risk managed. The other thing is the vast majority of hedge funds are managed by businesses that are owned by the people who run the money. So they're entrepreneurial, they're quite small businesses. There are several thousand hedge funds and over 1,000 hedge fund management companies. The assets under management are about $2.5 trillion, which is not much if you think that Legg Mason and Fidelity together are nearly that big. But their impact on the markets goes far beyond their size for 3 main reasons. The first is they trade actively, in some cases very actively. So they represent a big percentage of the turnover, particularly of equity markets. They can use leverage, and they can concentrate their portfolios. So for those 3 reasons, their impact on markets and on price discovery is major. And also they will intervene at times when other investors are going in the opposite direction or technically have to sell. And an example of that is in credit. Defaulted credit, a lot of investors are not allowed to own, or it's punitively expensive for them to hold it on a risk basis. Hedge funds at that point will buy the distressed debt and sometimes move to a restructuring. So I think that's probably enough at this stage on hedge funds. In terms of what they do, just who owns hedge funds, who invests in them. Historically, the biggest investors were family offices, endowments and foundations, and private banks. In more recent years, the biggest investors have been pension funds and sovereign wealth funds.
Okay, thank you.
I'm not going to sing a song, although you offered it, but I am going to talk about clean energy, its relevance to Turkey, its relevance to emerging markets, the world in general, to sustainability, and the development of Turkey as a foremost industrial power by the goal of 2023. So these are my views. They're not the views of my firm Good Energies, which is a manager of alternative energy technology and investments. We also invested in wind in Turkey. My colleagues did that. And the views will be often my own. I've been 24 years as technology venture capitalist. I started Intel Capital. I've invested around the world in places like Brazil, the US, China, India, built plants, software labs, etc. I started what became Intel Capital. I financed airlines, power plants, nuclear, coal-fired oil and gas. I'm on the board of a major university in Washington, D.C. and chair the sustainability committee of the board. And I'm also on the board of a Swiss green utility listed on the Bern Stock Exchange called KKB, and also an impact investor in Geneva, which does impact investing around the world, also in energy and sustainability technologies. Good Energies is part of the Kofra Group. I think you will know this in Turkey because they own the CNA brand and the CNA chain of clothing stores. They also own large real estate development company called Redevco, and I'm part of the subsidiary called Bregal, which is a 4 billion fund of funds. Good Energies was not started by me. I joined 5.5 years ago, started by one of the family members, Marcel Brennickmeier. It's a family-owned firm, and he figured out that tariffs, cheap silicon, PV technology, photovoltaic technology, and the world impact on climate change would come together and create a huge opportunity, and it happened. And we invested in firms like Q-Cells, REC, Trina, Solar Fund around the world. And I'm active in small companies, on the boards of small companies. Last week I was in California and came back from some board meetings. Cities, of course, you all know that urbanization is driving economic development and migration to the big cities. This is hard to read this slide, but most of the world will become urban during our lifetime, especially in places like India, China, of course, Turkey as well. I'm going to show you some slides. Energy is key to development, not just for the stock exchange, but for Turkey's goal to become a top 10 economy, to have export-led manufacturing to the $500 billion level by 2023, increased urbanization and need for everything from sanitation to power to internet use, and of course trading on the stock exchange. Energy needs in Turkey will double, and sustainable development is very important, talking to some of your CEOs last night and the night before. Global total new energy investment has become huge. In a decade, it's become a very large industry. In fact, global investment in clean technology is about the same as fossil fuel technology today. So we came from a base that was very small, and we are on the 300 billion level, going up and growing from there. New investment in clean technology, you can't see this slide very well, but an increasing amount is in the solar photovoltaic area and in wind. These are the two killer technologies for the future. Biomass and others are quite small, and they will be quite small going in the future. China's air quality and air quality around the world, a big deal. World Health Organization guideline of 25 parts per million. China went to a much higher level of 993, as we know, the last summer, and the Chinese government is very concerned about air quality in the cities. It is said that in northern China, it costs you 5 years of your life to live in such air quality. Globally, clean technology investment, China is leading, United States is up there, even countries like India are quite big, and Turkey will join this group pretty soon, but this is a big market. In just 10 years, it went from a niche market for aerospace and other areas to a very large market and a primary supplier of energy in the world. In Germany today, 23% of energy is produced by green sources, solar and wind. Why did this happen? Well, this is a technology chart that shows the photovoltaic modules and cells have declined by about 15% per annum in cost terms, and this trend will continue. It's a silicon technology, which means it always gets cheaper, just like a flat screen TV, and it will become the cheapest source of energy one day, 5 to 7 years from now. And that is without even having a price for carbon. If carbon pricing is introduced, it'll become cheaper much quicker. In the EU, you can see what the additions of technology are. Germany, Switzerland, Italy are all going to turn off their nuclear plants, or so they say. In other places, except for France, it's difficult to build nuclear plants today. And photovoltaic, called PV, is one of the big ones going forward now. Clean energy cost competitiveness, we've invested in Africa. Solar PV is a lot cheaper for a family to use than kerosene, and you don't have the risks of burning yourself, fire, etc. for kids studying or just cooking at night. Onshore wind has become much cheaper. It has not declined at the same rate as solar PV technology, but it's become a very optimized technology going forward. You can see these wind farms are getting cheaper and cheaper, much more technology involved. They're even talking about 10 meg solar turbines at the moment, which are huge, enough to power a small town. Improvements of technology from the blades to the transmissions to the technology to the sensors to how you orient the blades into the wind. And the best wind is getting competitive with natural gas at $6 today. $3 natural gas in the US has happened through shale gas. It won't stay at $3, it's going to go up, and of course they don't pay for the carbon. But natural gas and shale gas will be a worldwide trend, and I hope Turkey can take a benefit of that too. As far as battery technology, why is this important? Well, electric cars are coming. It's a booming business. It's a small part of the world economy today, but it'll become a bigger part of the market, and maybe Turkey can also join since it's a large car manufacturer as well. But batteries will get cheaper and better as time goes on. Smart meters are rolling out. In the old days, it wasn't quite clear what the energy company could charge you because the meter was analog and rotated and slowed down as time went on. But today, smart meters can tell you instantly what you're buying and what you might sell back to the grid if you're producing power yourself on your roof. Power additions in China by technology, well, you can see wind, biomass, hydro are all big ones, not just Three Gorges Dam, but solar PV as well. So what are the implications? Well, I came from the computer world, and the power world is going to go the same way as the computer world. I was talking to the head of Turkcell last night, and he said about everyone can be a publisher now with their cell phone. Well, everyone is going to be able to be a power provider to themselves and sell back to the grid eventually. And this is happening in some of the world which is deregulated, where it's not just a central place producing power for you, but you can produce power, sell it, you can buy it, you can sell it to your neighbor, and eventually you can store it and sell it later. But there's a whole re-engineering of the power grid and the power business worldwide. It'll cost trillions of dollars, will require the help of stock exchanges and capital markets, will be supported by government agencies, and largely will create huge opportunities and jobs also in Turkey. It'll also cause lots of risks and relocations for the dislocations for the existing power companies, existing transmission companies, and because the old models will change, and will cause some trade tensions as gas is moved around. Turkey is in such a central part where gas will come from Azerbaijan, from Cyprus, from other places, and go into Europe. So Turkey's in a beautiful position to capitalize on all this. And gas is an important part of the whole renewable chain, since gas allows you to have intermittency. Gas is useful when there's no solar PV or there's no wind going on. And climate change is a wild card. Anything can happen, as you know, given what happened with Fukushima. The capital requirements are huge, and I'm going to end with that. The capital requirements, we are underinvesting in capital required for energy technology in the world. I'd like to acknowledge some of these slides came from Bloomberg New Energy Finance, my friend Michael Liebreich, who started this firm 10 years ago. And I want to thank you very much.
Thank you, George.
I think maybe a little bit of kind of a history of how things have evolved in terms of how families manage their liquid assets. In starting Stanhope Capital, we actually had an American firm invest in us and partner with us, a firm called Bessemer Trust. And Bessemer Trust is an interesting example. They're probably not very well known in Europe and in Turkey, but they're quite a substantial firm in the US. They were formed in 1907, following the sale of Bessemer Steel, of Carnegie Steel, to J.P. Morgan. Andrew Carnegie, who was then the richest man in the world, he did one thing that is obviously an option. He gave all his money away to universities and to libraries, and is more well known for that today than his original business. His partner, Henry Phipps, put his money in trust for his family, allegedly about 50 million at that stage. And what did he do then? The asset management industry not being well developed, he decided to invest in other industrial businesses. And he did that in a meaningful way, and his descendants did that, until the late 1970s, when they opened up their firm to other families and started managing assets on a more diversified basis. Today, the Phipps family, if you ask them, have approximately 80% of their money in private equity. They started Bessemer Ventures, which is one of the, and George probably knows them well, one of the original Silicon Valley venture capital firms, which until recently only managed their money. And then they had a private equity fund, which they opened to other investors in 2000. So that is one example. And I think what has happened with the other examples, I would say, is that there are many family holding companies that exist in Europe and have existed for a long time, which have been a way for families to diversify and invest really in industrial assets. And I think Turkey is a very good example of that too, with some very important family holding companies. What has happened in the last 20, 30 years, I suppose, with the kind of development of the asset management industry, development of the capital markets, also, I think, evolution, good or bad, of financial theory, has come the perception that you need to be broadly diversified. And I think, there's obviously some merit to diversification, but there's also some drawbacks. I think the other element is that in terms of a family, to answer your question, how do they manage their money? It depends whether they are managing it or whether someone else is managing it. And when it is OPM, as we call it, other people's money, the appetite for concentration and risk will generally diminish. And therefore, the expected return will also diminish. And I think today, generally speaking, in the asset management industry, you have a range that is dictated by diversification, by liquidity requirements, by volatility management, which means that everybody is trying to give their clients capital preservation and also generate a return for their clients that is in a 6 to 8% range, inflation plus 3 to 5%, which obviously in this market, people talk about it, but it's very difficult to achieve. So I think that really dictates in a way the way portfolios are created within asset management firms, and they are therefore broadly diversified across asset classes, and sometimes, but not always, across geographies. We happen to be quite heavily invested in emerging markets, have about a third of our equity allocation in emerging markets, which is very different from what most people have, especially if they are hugging the MSCI, and the MSCI all-country index is only about, I think, 11% if I'm correct, in allocated to emerging markets. So there's a substantial difference. But I think so if you look across asset management firms, you will find portfolios that are fairly similar. If you look across the endowment world, you will find some differences. If you look at the Norwegian endowment, you will find that they are heavily not in alternatives at all, and probably that's a factor of their size. If you look at some university endowments, they have much more in alternatives. I think one thing that is that people are realizing is that the perverse consequence of over-diversification is obviously absence of return. And you have some of the Canadian pension funds that are now moving into making investments directly in private equity themselves, because what over-diversification also means is also paying fees to everybody. And the fees, I think, in alternative assets, on average, are not earned. I think, we mentioned hedge funds. I think the majority of the hedge funds do not earn their fees. The majority of private equity funds do not earn their fees. So at some stage, you have to ask yourself, are you going to take your destiny in your own hands and do some of it directly? And I think there is a move towards that from some of the pension funds. There is a move towards that certainly from some families. And I think the other, problem currently that exists in markets is a short-termism, which leads to people focusing on, what are the next quarter's earnings, as opposed to, is this a company that's actually going to be here in 5 years' time and grow its results? I think the same thing is true on a macro level in terms of what is happening in terms of GDP growth, earnings growth in a particular country. I mean, it's not what happens next quarter that matters. It's what's being established for the long term. And so the short-termism is something that is very widespread, but very detrimental to long-term returns. And again, diversification. If you look at some people who have made money with money, which is what we're talking about, most of them have been very concentrated. If you take the Benjamin Graham school, and you look at obviously the current example of that, which is Berkshire Hathaway, it was a very concentrated portfolio. It is less now because of the size of it, but that is the philosophy. And over the long term, I think Albert Einstein is supposed to have said that the eighth wonder of the world was compounding, and I think there's a tendency to forget that.
Okay, thank you. Peter, you mentioned about, the new era, new environment, where we are standing for the time being. And especially you emphasized the role of endowments or similar funds. Do you think that for emerging markets especially, the institutional investors can play, both domestically and globally, can play a role to smooth out the volatility, especially during troublesome times? And or what should we do as emerging markets to create a market-friendly environment to attract more institutional investors?
Yeah, well, one of the things which Sandy's talked about at length is to do what you've been doing, which is creating a transparent, efficient and low-cost, safe market in which we can trade on behalf of our clients. So we applaud that, and also the regional ambition. But I think we've been investors on behalf of our clients in Turkey for many, many years, over 10 years, and sometimes in quite considerable sums. I think there's no question that if you can provide that level, that safety, the assurance that the market is going to be good governance, that the counterparty risk is low or minimal, and liquidity will gradually increase, maybe by attracting more companies to list from around the region. I think you'll persuade companies, sorry, am I too close? No, too far. You'll persuade more and more companies, investors like us, to stick with a market when it does go into trouble. And I can think of a few, not here, but another company within this country, within this region, where a lot of the investors have panicked and ran in 2008. And perhaps we weren't quick enough to get out, but we didn't. And actually that was the right thing to do. So I think creating an environment in which big investors can have the comfort that the governance is there, hopefully the liquidity will grow, is the first and the most important thing to do. I think and you're doing the right thing.
Thank you very much. We have
Well, I think that I think good regulation basically is enabling, and we're seeing basically. I personally think that there's been a lot of talk of unlisted investments and so forth, and I think that's part of the general investment ecosystem. But I think that it's very important to have to encourage inclusiveness, to actually provide the investment opportunities to the broadest number of people. And that basically means intelligent regulation, and it means transparency, and it means basically encouragement of development of listed opportunities that the general investor can take advantage of. Because otherwise, basically, it's just investment opportunities for an international elite. And I think that basically is I think not really sort of conducive to in the general interest of people. So and I think that on the subject of regulation, sort of good and bad regulation, I think that clearly in certain areas we need more tighter regulation, but I think that in other areas we need less. And so it's really important to strike the right balance. And I think that capital will flow more readily to jurisdictions that actually get that balance right.
But do you think that the regulatory differences between the advanced economies and emerging markets where you are looking for investment opportunities, would matter, or it doesn't really?
Yes, I mean, I think that that in terms of when comparing assets listed on developed markets and assets listed in emerging markets, I think that there is, currently we have to factor in a risk premium that is related to governance, transparency, and the effectiveness of local regulatory environments. As those improve, as you see convergence, and you're seeing obviously rapid convergence from a technological perspective, then I think basically those risk premia, the risk premia demanded, all things being equal, will reduce. And I think that process can happen pretty rapidly. What is slow are investor perceptions, because at the moment still, despite the rise of sovereign wealth funds that are often basically based in the emerging economies, I think that basically investor perceptions are slow to change, and so their perception of risk is sort of somewhat outdated. And so therefore, even though the quality of exchanges and jurisdictions does improve rapidly, I think that investor perceptions, at least in terms of where a lot of the capital flows are directed from, basically are going to change more slowly, so that will take time. But I think the trend is pretty obvious, and there will be discrimination between jurisdictions and regulatory environments that actually are progressive and understand how to get the balance right, and there will be other exchanges and regulatory environments that which really struggle to attract capital.
Okay. Andy, you have listed those people, they are talking about alternatives. Have we already come the end of the game, or we have still hope for survival?
No, I don't think we've come to the end of the game. In fact, I think we're in the beginning of a new round. You introduced me at the very beginning as being the first visitor that you had from abroad. I will characterize, I will honestly give you an insight into why I made that visit. And it had to do with what this panel is about, to a certain extent, asset allocation. NASDAQ had to make a decision about where it was going to allocate its resources. We had looked at Turkey. We had never really done a lot of business in Turkey. And you were new to the scene. You were an academic and a central banker. And what the heck were you doing running a stock exchange? And, but when I met you...
I don't know either.
I had the same feeling about myself when they sent me to Philadelphia. But when I met you, it reminded me, ironically, about a hero. You reminded me of a hero that I had growing up. His name was Robert Kennedy, a man of great energy, who would almost universally, in all his speeches, end it with a quote from George Bernard Shaw. And that quote was, "There are two kinds of men in this world. There's the kind of man who looks at the world and asks why. I dream of things that never were and ask why not." Now, when I met you, even in that first conversation, and I heard what your vision was and your approach was, I was very impressed, but I was somewhat skeptical. I couldn't believe that you were going to achieve the things that you were setting out to achieve. Now, when you're running a stock exchange, and the only part of the exchange that you really have of substance was an equity piece, in a country that has been known for a certain amount of, let's call it diversification or whatever, and yet within 1 year, you were able to take all of the various kinds of exchanges that exist in this country and clearing and consolidate it into a cohesive entity called Borsa Istanbul. In a world where traders trade equities and hedge against a world of other kinds of products, in a world that screams for coherence, good governance, transparency, to be able to pull that all together into a central clearing operation and consolidate that into this vertically integrated enterprise was stunning. So when I think of it as a new game, I look at the aspirations that you have, that Turkey has, to becoming a world financial center. I think it's a place where NASDAQ wants to be. I think it's a place where the world is going to want to be. You have partnered with us on a technology system to integrate all of those various enterprises, but to go way beyond it. To be able to be a host country for emerging markets in this region and beyond, so that you can provide technology to them. When you talk about energy, you also talk about resources. A lot of emerging markets simply do not have the capital to invest in appropriate kinds of capital markets, starting with technology systems. And you have an aspiration of being a hub, a technological hub as well as a financial hub. So when I look at the new game, when you look at the future, I think that a stock exchange as a flagship for the financial system of a country was the old model. For certain countries who are blessed with certain kinds of assets, to use those assets to become a regional financial center, a regional technology center, is the new game. And we obviously have put our assets and our resources where we believe the future lies. I think that what you have put together here is already being recognized. You know, I sit on the board of the World Federation of Exchanges. Within the first year, in a very hotly contested election, you won a seat on the board. And that wasn't given to you. It was earned, because all of the exchanges have recognized the extraordinary achievements. So I don't think that we're at the end of the game. I think it's a new kind of game. As I said before, I think the opportunities for capital markets, for companies in Turkey to look at capital markets as a place for capital will grow. The integration of the markets, and with it, the good governance, the 21st century technology, really is going to be a very exciting game for the future, and successful one.
Thank you very much.